Welcome to our course on RegTech, where we're going to be talking in this first module about FinTech security and regulation, and why we refer to this collectively as RegTech, or what do we mean by RegTech, and how does this intersect the worlds of security and regulations in the context of financial services innovations using technology. Now, as we think about finance markets in general, one of the most fundamental aspects of finance is the management of risk and the element of risk as part of financial industries. Essentially, banks as institutions evolved and emerged to reduce or manage risk of one sort or another. They were vaults and secure places that would reduce risk of theft, risk of your money being stolen. They also, by pooling returns, they can help you reduce risk of any particular business going bad, any loan. You can make a loan to another company, but if it's peer-to-peer lending and there's no pooling effect, your risk is higher for the same return. So you have better average returns with lower risk with a pooling effect, and this economies of scale is part of what banks do. The risks of fraud go down as you're able to better review documents, better collect data, and have more competence in a centralized lending authority. And more capabilities to do some kinds of insurance or reinsurance. The whole insurance industry, not banks necessarily, but other ways of reducing risk or reducing cost to society or to investors. And so a lot of what we do in finance has to do with management of risk or reduction of risk. And regulation also plays an important role in reducing risk. In fact, security, like physical security or digital security, and regulation, both are focused on this idea of reducing risk or managing risk in society and for investors. And so that's why we have security, to reduce risk, risk of crime, risk of failure, risk of collapse, and that's why we have regulation, is to reduce risk. So there's a common theme here. Now, risk isn't always bad. Many times in financial markets, people talk about risk versus return. And if you have higher risk, you may be able to have higher return. Lower risk usually means lower return. So you can have your money's guaranteed. You can invest in a one-year treasury bond with the U.S. government, and you will say, my risk of not getting paid is very, very low, but the money that I'm going to get on my money is also very low. But I could lend it to a startup, and I might make huge returns, but I might lose all my money too. So essentially, one of the things that enables banks and insurance companies to make a lot of money is by converting high-risk ventures into low-risk products that they'll sell to investors. They will loan money in more risky areas like small business loans and get a high return for that. So they'll make a lot of money on their money, and they will then go to an investor and say, we will give you a CD, which is guaranteed to give you X return in a year with a small return. And so by pooling high-risk investments, they can then package that in a way that they can sell to other investors as low-risk investments, and by pooling risk, they're able to get some nice profits. They also gain profits or benefits from economies of scale and operations that a bank has a lot more ability to do: financial services, verifications, loan documents, investigation, thinking about risk, looking at data mining, etc. They can do that in a more efficient way than a small business could or an individual investor could. And so there's some operating economies of scale that also help them to make money. Investors will make more money if they take on more risk, but there is some benefit to the pooling and to the operating efficiencies. And so many investors, even when going for high risk investments, may seek some sort of financial service intermediary role in either operating efficiency or pooling of risk. So they may put money in a mutual fund, may put money with VC investors who will have operating efficiencies of looking at the startups, approving documents, doing more services. So you can invest in a VC fund, or you could say, you know what, I'll just choose to be an angel investor and go contact companies directly. But then you have less pooling and you have less operating efficiency, and you may make very different returns. You may have very high returns, but you may have very high risk as well. And many times investors will make that trade-off. They will say, I will take the higher risk in return for higher profits, sometimes through a financial intermediary, sometimes directly. And so one thing fintech can do is enable us to have more opportunities, perhaps for pooling or perhaps for more efficiency, and enabling individual investors to do more with their money by disintermediating third parties in some cases. But we have to be careful, because higher risk does not always mean higher profit. There's an old saying, high risk, high return, but it's not always true. Sometimes you can take high risk and have no return or negative returns that are very, very bad. Fraud is an example. Many people go chasing high returns and they think, oh, yeah, I'm willing to take the risk. Well, that risk may be much higher than they thought. They may not have realized how much risk they were taking. They may have far underestimated. And this could be in many different areas. Right now, we see a lot of enthusiasm for cryptocurrencies, but we've seen a lot of enthusiasm for stocks. We've seen a lot of enthusiasm for real estate. We've seen a lot of enthusiasm for gold. We've seen many, many different manias or different exuberance levels over the past several hundred years of people getting excited about one market or another and saying you can't lose. Well, you can. And so you have to be careful, because it's not bad to take higher risk for higher return. It is bad to underestimate that risk and not appropriately plan. So sometimes the risks are higher and the returns are lower than expected, particularly when there's fraud or misrepresentation or poor information, lack of ability to understand what somebody is telling you. And this can lead to financial services meltdown, banks and investors not understanding the risks associated with CDOs, collateralized debt obligations. You may not know what those are. Doesn't matter. Neither did some of the people buying them. But their net effect on the overall economy was disastrous. And so it cost you jobs, it cost you your savings in some cases, because you didn't understand, and neither did many of the professionals in the finance industry, how much risk they were taking. This may also be the case with some crypto investors who certainly have upside. No question about that. Volatility's high. But certainly more risk than some of them are realizing they're taking. Not all, but the risk is real and you need to recognize it.